Frontline indices dip further, but some recovery is noted in mid-caps with advances outnumbering declines. Realty and financials are the big losers, even as energy and metals eke out gains.
While TCS is expected to report higher revenue growth and slimmer margins in Q1 following a wage hike, the focus will be on its commentary on demand, hiring and traction on Gen AI when it announces its earnings later today.
After selling 75% stake in Glenmark Life Sciences to Nirma, Glenmark Pharma and promoter Glenn Saldana have now floated an offer for sale for their residual near 8% stake. This move will see Glenmark exiting the life sciences business entirely.
RBI has now permitted all residents to open forex accounts in GIFT City for all purposes. Earlier, such accounts could only be opened to buy securities of overseas companies or for foreign education payments. Hello and welcome to Halftime Report. I'm Ekta Batra and with me is Mangalam Malu. Well, it's turning out to be a session which is a bit sluggish at this point in time. So we have the Bank Nifty, which is down around 0.6%. But what is doing better is the broader markets. The mid-cap index is managing to hold up with a gain of around 0.2% at this point. And the advanced decline ratio is positive as well. So at around 1.24 to 1, or around 2,100 stocks advancing to around 1,700 stocks declining on the Bombay Stock Exchange. Let's see whether that sustains. Besides the TCS numbers, we do have the US CPI data, which will be out today for the month of June. And that's expected to probably see a little bit of softness on a month-on-month basis. And that will set us up to what we can expect from the US Fed when they meet at the end of this month. Hi, Mangalam.
Hi, good afternoon. Yesterday we tested the lower end of the range. Today, in the morning itself, we tested the higher end of the range for the Nifty. So between yesterday's low and today's high, we have 24,150 to 24,400 on the frontline index. We've fallen about 180 points from the highs, but at the same time, we've seen a bit of a recovery from the lows as well. Currently, the Nifty is sitting with a cut of about 100 points. The broader markets, like you pointed out, doing a lot better. What's also interesting is that, a bunch of stocks which are actually doing very well in today's trading session. So we do have, all these energy companies. So we have HPCL, which has moved higher. We have Oil India, which has moved higher. We have some of these power financiers as well. All the PSUs, the ones which actually led the rally on the way up. We have REC, PFC, BHEL, all of them doing extremely well. And apart from that, a couple of these, other companies as well. Case in point, something like a Sun TV, which has crossed the 800 mark, currently sitting at the high point of trade. But let's get in some market opinion. We do have with us Nilesh Shetty, who's joining in, portfolio manager at Quantum Advisors. Good afternoon, Nilesh. Thank you for joining in. All the opinion that we get so far talks about how India is the brightest spot in the world right now, but that is also the most expensive in the world right now. How do you navigate through this, and what is it that you're doing in the markets?
Yeah, we agree with that. India has always been expensive. That is not a surprise. But it looks like it, relative to the earnings cycle, the valuations are much above normal right now, especially in the mid-cap and small-cap space. No matter what earnings growth you want to peg there, I think valuations have moved far away from fundamentals there. We remain stock-specific, and there are pockets of opportunity. I think for us, incrementally, we see more of our capital being deployed in private sector banks, including on the savings side. So we have deployed capital on the insurance side of savings, AMCs, and broking companies. So that is where we found opportunities. But apart from that, generally cash levels in the portfolio have been inching higher as we've been trimming a lot of our other positions in the portfolio.
Okay. Nilesh, hi, welcome to the show. We do have TCS, which will be reporting numbers today. What is your sense in terms of what we can expect when it comes to revenue growth, margins, which is expected to be impacted on account of the wage hike, as well as commentary, especially on demand as well as artificial intelligence?
Yeah, I will not be able to comment on individual stocks, but IT is one of the few places where valuations are not extremely expensive. They're not relatively cheap, but within the context of where we are in the market, it is one of the few places that warrant allocation of capital. Wage hike generally is known. It is not something which every Q1 number is a wage hike quarter for all IT companies. So it's not a surprise as such for the market. But what most people are looking at is, most of these companies have picked up large orders, and the the order book remains very healthy, which is not translated into revenue as clients keep deferring spends. And most people are waiting to see signs of that order book getting translated to revenue, which may see a pickup in valuations for these companies. AI, I mean, we are still trying to figure out how it impacts. I mean, there is a mixed opinion whether it's an opportunity or a threat. But historically, most of these disruptions in technology have been opportunities for Indian IT services companies to expand their share of wallet from the customer. It may not be that different this time as well, but we'll wait and see. As of now, we sort of sitting on the fence on the disruption that is coming.
Could you tell us what your allocation is right now, what your positioning is, underweight, overweight, equal weight, what sectors, and what are you incrementally doing in the market?
So the portfolio is built bottom up, and the sector allocation is an end reflection of that. But we have about 40% in BFSI, including large private sector banks, insurance companies, and a broking company, and asset management companies. We have zero allocation to consumer staples. They are getting interesting for us given the underperformance that has happened over the last 3 years. We have zero allocation to capital goods and infrastructure space. That is where we see the maximum froth in valuation. I mean, they remind us of valuations that we saw in 2006-07 for these companies without the same kind of earnings traction, which tells us that the valuations are far above where they should be. And we've essentially trimmed our allocation in auto, where we had a large allocation a year ago, but we probably halved our allocation now as valuations have become expensive.
So where are you deploying this money that you're getting? Because you have zero exposure to staples, 40% to BFSI, a little on IT, like you said, and then you have a bunch of others. Auto, for instance, you halved your allocation out there. So what exactly are you looking at? Because even cap goods is something that you're finding very expensive.
Yeah, I mean, portfolio is sort of built with a 5-year view, so we have to be patient. Opportunities will come. Like I said, there are pockets where underperformance sort of has emerged over the last 3 years, including consumer staples, including consumer durables, which were growth favorites till, say, 3 years ago. They were the capital goods of the previous bull cycle. And given the valuations, earnings have disappointed. And so we expect that disappointment to continue. And at some point, opportunity might present itself for us to add some of these names to our portfolio.
So what's the cash that you're sitting on right now, and how does that compare to your historic cash levels?
So the cash today is about 15%. Our long-term average has been about 10%, but it has increased over the last 1 year. It has moved up.
Okay. All right. Well, your cash has moved up from 10% to 15%. You did mention autos. You've reduced your reduced your exposure there. You know, autos have been in focus on account of those SUV price cuts which have taken place. M&M has said that it's a part of their annual plan as well. But are you fearing maybe a contraction in demand, softness in demand when it comes to the auto space?
I mean, we try to model long-term growth in demand based on penetration levels, and there could be interim cycles where demand is higher or lower than that. But the worry was valuations. The valuations for us, based on the earnings growth that we were forecasting, were trading above where they should be. And there has been, most of them have doubled over the last 1 year. And earnings growth has been in the range of 25-30%, which has expanded price to earnings multiples quite materially in that bucket. So it's purely a valuation number, not necessarily we have a major view on earnings disappointment in that space.
Okay, so where exactly are valuations looking comfortable for you at this point?
Like I said, the 40% allocation remains in BFSI, which includes private sector banks, includes insurance companies, an asset management company that we picked up last year. And then incrementally, we are sort of observing the consumer durables and consumer staple space closely, which, like I said, is been underperforming for the last 3 years now, and still not cheap enough. We picked up one company there, which has done well for us, but it's a space where I expect more names to come through over the next 12 months.
Okay.
Is your portfolio market cap agnostic? What are you looking at in terms of when you say bottom up? Are some mid cap opportunities attractive, or is it just the large caps that you're looking at?
It is a market cap agnostic, but we have a liquidity filter given the size of the portfolio. We need at least $1 million a day daily trading volume. And because of that, there is a large cap tilt in the portfolio. But if a liquid mid cap company which meets our corporate governance norms, because we run an integrity screen on corporate governance for most of these companies, if they meet these two criteria and then meet our valuation criteria, we are happy to add them to the portfolio.
So what are you, so based on your criteria, you know, and the filters that you have, What is your exposure within the broader markets? Which are the sectors that you probably lean towards? Or is it more stock-specific, story-specific?
It is completely stock specific. The end sector weights are just the outcome of individual stocks that we picked up at different points in time. But we don't have a view as such saying that this is the sector we need to increase weight at the moment. So if tomorrow a capital good company meets our filters and comes at a valuation that we are comfortable, despite the view on the overall sector that looks expensive, we are happy to add it to the portfolio.
So what would some of your recent additions be?
So like I said, the most sort of recent addition has been a private sector bank, which we picked up. I may not be able to disclose the names. And before that, there was a consumer durable company, which was sold off quite materially, which we added. That has done really well for us. It's actually virtually doubled from the price that we picked it up in the last 1 year. And then this bank remains a place of interest. And there are other sort of financials that we're tracking right now, where we think more names could come through.
Is this the large private sector bank that everyone keeps talking about, or is it something in the mid or not so small cap space sort of thing?
Top three, one of the top three private sector banks, not the largest, that we already had in the portfolio.
Okay. All right. We're going to leave it on that note. Nilesh, thanks very much for joining in and speaking with us. And we'll touch base with you as and when, earnings season progresses. Thanks very much for joining in. We'll take a short break, but a quick programming note. Will the RBI cut rates this year? Is the Reserve Bank of India worried about a bubble in the stock market? Is India poised for a GDP upgrade? Coming up later in the day, a CNBC-TV18 mega exclusive, the definitive RBI governor interview only on India's most watched business news channel. Stay tuned.
Welcome back. One of the stocks which is holding up in the green right now is Reliance. Despite a slightly wobbly market, the Nifty is down about 58, 59 points. So when we started the show, the Nifty was down about 100 points. Thereafter, we saw some bit of recovery from the Nifty Bank, which is down 0.7%, is now down about 0.6%. So as you can see, a big decline, and then that was swiftly being bought into, and that mirrors the way the Nifty Bank performed as well. But Reliance is still holding up in the green, and that's because of a note that came in from Jefferies this morning, which says that Jio actually may be listed in this year itself. That's the word coming in from them. What are the scenarios? What are the valuations? Rima joins in with the details of the same. Rima.
Thanks so much for that. So the key thesis by Jefferies is that a Jio IPO is likely in calendar year 2025. Now, Reliance has two ways to go about an IPO. One, do an IPO with Jio remaining as a listed subsidiary, or two, spin it off and list it like they did in the case of Jio Financial Services. Now, in option number one, where Jio remains as a listed subsidiary. Now, Jio can exercise greater control on, Reliance can exercise greater control on Reliance Jio, but there is a holdco discount. And the fair value of Reliance Industries declines if the holdco discount assigned by the market goes up. So, for instance, with a 10% holdco discount, the target price, according to Jefferies, fair value should be 3,473. But if you increase the holdco discount to 30%, then the target price drops by nearly 200 rupees to 3,257. Now, option number two is they spin off the telecom business, Reliance Jio, and then list it, like they did in the case of Jio Financial Services. You do a price discovery, shareholders in Reliance will get proportionate shareholding in Jio. Now, the advantages of this are that there's better price discovery, it's better for minority shareholders. Jio Financial Services has created a lot of value, but for Reliance Industries, and plus there is no holdco discount, but for Reliance Industries, the control comes down because Reliance Industries will now have about a 33% holding in Jio. But in that case, if they decide to spin it off and then list it, then the fair value of Reliance Industries is at 3,580, higher than the previous option scenario, and that's because of the absence of a holdco discount. Back to you.
Okay, all right, Rima, thanks very much for that. So a possibility in terms of IPO for Jio next year. But let's move on now to the cement space. Ambuja Cements is in focus now. The brokerage firm Nomura has upgraded the stock to a buy and also raised the target price. Nigel is here with the details.
Well, that's right. Nomura is sounding quite optimistic on Ambuja Cement's prospects. So from a reduce, they have upgraded the stock to buy, and the target price from 500 rupees has gone to around 780 rupees. What are they factoring in? Firstly, they're giving it a higher multiple. Earlier, they've given it a multiple of around 14 times. Now they're willing to give it the target price a multiple of close to around 19 times. Remember, Ultratech Cement, for them, they're given a multiple of close to around 17 times. Let's break it up into 4 big reasons. One is they're impressed with their capacity addition. And they're saying over the next few years, that's FY24 to FY26, they're expecting capacity addition at a pace of around 14%. They've included the Penna acquisition as well. And they're saying that will outpace the industry. For the industry, they're expecting the industry to add capacity at around 6%. And for Ultratech Cement, in the same duration, they're expecting to add capacity of around 9% odd. At the end of FY26, they're expecting that Ambuja Cement's capacity goes to around 106 million tons. That's including the Penna acquisition. Next up, the entry into new markets. They're impressed with that. So post the Penna acquisition, they are saying that Ambuja Cements now, on a consolidated basis, becomes the 3rd largest player in South India after Ramco as well as Ultratech Cement. And they are impressed on that front. They also say that the 2 acquisitions that they've done, Sanghi as well as Penna, both of them have an adequate amount of limestone. So it helps them in case they want to go ahead with brownfield expansion, which is a bit of a trigger as well. Point number 3. On the volume growth side as well, they have not factored in any contribution coming in from Penna, but still they believe that Ambuja Cement's volumes, well, it'll grow at around 13%, excluding Penna, and that compares with around 11% for Ultratech Cement and around 5% for the industry. And point number 4 is a company-specific thing. They're saying the cost optimization measures will start playing out. Remember, the management has been talking about alternate fuel resources, about sourcing coal domestically, and also the synergy benefits for the group on the whole. Put everything together, Nomura is saying that they expect Ambuja's operating cost to reduce by close to around 300 rupees on a per ton basis. So 4 big reasons explains why they have gone ahead and upgraded the stock. Back to you.
All right, Nigel, thanks a lot for that. So that's about Ambuja Cements, the entire cement pack in focus today. This one on the back of the Nomura note. Yesterday, remember the same time we were having a conversation with Shalby's Shanay Shah, and now Shanay actually, and now it is up about 5% because immediately after that conversation, I think they went ahead and signed that lease with Asha Parekh Hospital.
Yes, absolutely. Well, we should have probably spoken to them today as compared to yesterday. But yes, the news on Shalby is that they've signed a 30-year lease for the Asha Parekh Hospital in Santa Cruz, Mumbai. And this will be to construct a new healthcare facility of around 175 plus beds. Now, remember that just to reiterate a couple of things that they said to us, which was important, was that remember that they came out with their Q1 numbers. It was a little disappointing on the margin front. And the reason for that is because of the Sanar Hospital acquisition that they made in the north. It broke even on EBITDA, but it was loss-making on the bottom line. So it basically impacted their entire performance this quarter. They expect that Sanar acquisition to be EPS accretive next year. They're expecting around 120 to 150 crores from it. The implant business has grown 50 to 55%, and they expect that kind of growth to continue. They expect a possible positive EBITDA this year from the implant business. The RPOPs, they're very positive on. Above 43,000 rupees is what they expect this year. And it's grown around 5 to 6%, which has been something that they could pass on. So interesting that they will be entering, a prime market such as Santa Cruz in Mumbai. But we'll wait by for more details in terms of, what they expect the occupancy level would be, whether it would be a multi-speciality hospital or maybe whether it would just be focused on orthopedics. So interesting times for them. The stock, as you can see, is up around 4.4%.
All right, so that's about Shalby Hospitals. But Ekta, even Zydus Life, that's at a 52-week high. There are multiple news pieces there?
Yes, there are in fact a couple of news pieces with regards to Zydus. So I'll just start with a couple of, drug approvals that they've got. So they've received approvals for a particular drug, which is Entresto generic, which is used for heart failure from the US FDA. The market size is around 5.5 billion. So it's supposed to be a big opportunity, but let's see which other companies also get approval for the same drug. They've received a tentative approval from the US FDA for Vumetry generic, which is basically used for multiple sclerosis in adults, and that's around $847.4 million. Remember, it's a tentative approval, not a final approval. The company is also in focus because they are barred from selling a cancer biosimilar in the Indian market for now. The Delhi High Court has issued an interim injunction which restrains Zydus from selling the breast cancer drug Sigrima, which is a biosimilar version of Roche's drug pertuzumab. Now, Zydus had told the court that they had got a conditional approval on April 4th. Then they were given final approval on the 27th of June by the National Institute of Biologics. But, the Delhi High Court has put an interim injunction on it. Even Zydus and Dr. Reddy's had entered into an agreement to co-market this drug in India. So that also is pretty much in limbo at this point in time. So it'll be interesting to see what the developments would be. But as of now, there's an interim injunction on this particular cancer biosimilar for Zydus.
All right, Ekta, thanks a lot for that. So that's about Zydus. Just before we slip into a short break, keep an eye on a couple of these stocks which are buzzing around, and they belong to the shipping / logistics sort of sector. Gateway Distriparks, for instance, is up around 7% right now. A well amount of volume activity out there as well. Not too far away from its 52-week high. And the other group company, Snowman Logistics, a stock in which the promoters of Gateway Distriparks themselves are increasing their stake, and they've on record here on CNBC-TV18 said that, will be looking to increase the stake by a further 5% this year as well, after a 5% increase last year. So that's, another pocket which is buzzing around. And Shipping Corp of India, it had seen a big move this morning itself, and now it's only extended its gain, currently locked in that 20% upper circuit with a fair amount of volume activity taking place out there as well. Shipping Corporation, SCI, is the one that should come up for you on your screen right now, currently at the high point of trade, in fact locked in that 20% upper circuit. Along with that, we have GE Shipping as well. So that's SCI and GE Shipping up around 8%. Take a short break, come back, get you more on the markets, and a technical trading ideas coming in from Nagaraj Shetty, who joins in from HDFC Securities. Welcome back. You're watching us here on Halftime Report. Perfect time to get you the F&O update at midday as well as the trade setup is. The Nifty is somewhere in the middle of yesterday's low and today's high itself. And that's exactly where, the range of the Nifty is more or less. So if you just take a look at the levels, yesterday's low was 24,142, which coincided with the July 5th low as well, which was closer to 24,169. And we have today's high, which is 24,402, which is again around 50 points away from a fresh record high as well. So the broad range on the index, 24,150 to around 24,450 is what the street is pinning its hopes on. And the Nifty is consolidating right around that itself. What's good is that the mid-cap index is outperforming, and the broader markets, if you look at the advanced declined lines, you would see that, there are more number of stocks which are advancing as against the number of stocks which are declining in today's trading session. So you have the green line much above the red line all through today's trading session. The other thing that is standing out in today's trading session is that despite the volatility that we're seeing in the market, after a bit of a rise in the last couple of trading sessions, the India VIX has begun to cool off. So mid-caps doing well, India VIX coming down means that maybe the downside for the market seems to be a little more protected. Add to that, as we speak, the mid-cap, rather the put-call ratio on the Nifty 2 is moved towards 0.7, 0.8 from levels of 1.3 yesterday. The Nifty Bank is a concern, down 3% from the highs, led lower by HDFC Bank. From last week's low, a high of almost 1,800 rupees, HDFC Bank is come down to closer to 1,600 rupees. So it's a decline of nearly 10.5%. So what happens in these two indices is something that we will have to monitor going forward as well. For Nifty options expiry today, we're closer to that 24,250 mark. So 24,250 call as well as the 24,250 put. Both of them come up for you. Very active in today's trading session, a combined premium of almost 60 rupees. So those who are writing both the call and the put, which we know as a straddle, are writing it for a premium of 60 rupees and hoping for this range of 24,200 to 24,300 on the expiry itself, 60 points on either side of 24,250 itself. One stock which stands out in terms of an up move today is Sun TV. A lot of long positions being added, upwards of that 800 mark as well. Let's see whether it sustains here or not.
Okay, all right, Manglam. Thanks very much for that. Nagaraj Shetty, technical research analyst at HDFC Securities, joins in on the show to discuss the technicals now. Nagaraj, welcome to the show. Well, let's start with the Bank Nifty, which is under pressure. It's down around 0.5%. What would your approach be towards that index in particular?
Hi, good afternoon. Bank Nifty has been a highly downward correction from the high of around 2353, 200, 300 odd levels. I'm not expecting any bigger reversal as of now. Though Bank Nifty has placed at the support, there is a possibility of upside bounce from the lower levels. I think 51, 500, 600 is going to be a support for the banking sector. I'm expecting upside bounce from here onwards or from the slightly lower levels.
Okay, all right. And specific stocks, what's your approach today?
Yeah, I have a couple of stocks, especially from mid cap and other sectors. As we know, sector rotation is happening. I have one stock from a financial side is LIC. If you look at the chart of LICI, it has been a larger consolidation pattern on the weekly chart. It is currently placed at the resistance of around 1050-55, which is a downsloping trend line. I'm expecting the overall chart pattern is indicating that this hurdle is going to be taken out on the upper side. One can look to buy around 1047, 48 levels, and the initial target would be around 1105. One can place a stop loss around 1020. I have one more stock, that is Syngene. And Syngene was in a structural movement at the lower levels. 650 has proved to be a good support for the stock and bounce back from the lower levels. Current upside bounce has taken away the resistance of a downtrend line currently placed at the higher levels. Overall chart pattern is looking positive. RSI and volume is also supporting for a further upside for the stock price. Currently trading around 745, one can look to buy at this point of time. And the upside target would be 805 and 720 is going to be the stop loss.
Okay, all right. We're going to leave it on that note. Thanks very much for joining in and giving us all of those stocks in focus. Well, a quick programming note before we slip into a break. We have a big budget exclusive for you today at 3:30 p.m. The CNBC-TV18 CII Budget Town Hall. The entire top brass of the industry body will be in attendance and we'll quiz them on their budget expectations. Sanjeev Puri, Sanjeev Bajaj, Neelkant Munjal, R. Mukundan, Chandrajit Banerjee, B. Tyagarajan, Shenu Agarwal, Vinod Agarwal and many more will be speaking exclusively at the town hall. For 25 years, CNBC TV18 has been covering the union budget, so keep it with your budget destination for the big newsmakers and exclusive news breaks.
Welcome back. We were speaking about Gateway Industry Parks doing well. Look at the industry leader out there, Container Corp. That's moved to the high point of trade. Alongside that, we are seeing some traction in a lot of these other PSU names as well. Oil India, HPCLs are a couple of stocks that we pointed out at the start of the show itself. Let's look at Petronet LNG. That one too has moved higher. And on the way up, we are also seeing some traction in names like Polycab and Bandhan Bank. Bandhan Bank actually had seen a big gash over the last couple of trading sessions. In fact, this week, despite the up move that we're seeing today, is down about 4%, but currently has moved higher with a gain of almost 2%. Speaking about rail and rail-related companies like Container Corp, etc., this morning we spoke with the management of Texmaco Rail and Engineering. Remember, the stock has seen a 60% gain this year so far, pretty much in line with the kind of gains that we've seen across the railway-related themes. And over the last couple of years as well, it's been a big mover. And earlier today, we asked the company about growth plans for this year, expectations of the union budget. They said that this year they would grow between 40-45% itself. But for the budget, they're absolutely fine, even if the government does not increase the allocation, because there is so much headroom available already that it will not, put any, break to the growth that we're seeing in this sector itself. Hear the management out.
As per the interim budget, whatever be the outlay was planned, which was significantly in line with the expenditure which railway did. So we as a stakeholder look at it from a little long-term perspective rather than a year-to-year thing, because we all have seen there is a shift based on a plan in last couple of years. So I will not be astonished if it is being increased a bit in terms of as an impetus to the infrastructure. But even if it is the same, it is good enough to, to fructify the plan what government has in the near horizon for 5 to 7 years time. It gives enough room for us to play and to grow the way the industry is doing in last couple of years.
Okay, all right. So that's on Tex Maco. But the big focus today will be TCS. It will be reporting its first quarter earnings later today. Rima is here to tell us what to expect.
Thanks so much for that. So for TCS, we're expecting a modest improvement in their revenue growth. 1.3% on a quarter-on-quarter basis in dollar terms. Constant currency revenue growth is up 1.5%. Now, typically Q1 is a seasonally strong quarter. There is a ramp-up of large deals like BSNL. All that will aid the top line. And revenue growth this time will be better than what we've seen in the last couple of quarters. Margins will come under pressure, down 150 basis points according to our poll, because of the wage hike, and that puts pressure on the company's profitability. So the CNBC-TV18 poll is seen down close to about 3.5-4%. TCV might be lower. TCV stands for total contract value. That's the deal wins, and that could be down quarter on quarter compared to Q4's bumper number of over $3 billion due to the absence of large deals. Now, what's the street going to track? They're going to track on the pace of recovery. There is hope that things pick up a little bit, at least in the second half of the year, and then accelerate in FY26. Is there anything in the management commentary which gives confidence regarding that? I've compiled what the street expects from TCS in FY25 and FY26 in revenues and margins, and that will come up for you. The street is expecting about a 5.5% revenue growth this year, accelerating to 8-9% next year. Margins too are likely to improve this year and in the following year because the employee wage bill has been coming down, with the companies hiring less and less and attrition coming under pressure. So the pace of recovery, is there scope for margin improvement over the next 2 years, which the street is hoping for? I think they want evidence of that in this quarter's numbers. Other than that, you will watch for things like hiring, generative AI, the pickup over there, what the pipeline is looking like. And even, if there is any increasing competition coming in from global captive centers. Back to you.
Right, Rima, thanks a lot for that. In fact, stay tuned to CNBC TV18 as we will be speaking to the TCS MD and CEO K. Krithivasan, the CFO Samir Seksaria, and the CHRO Milind Lakkar tomorrow at 9:45 a.m.
Welcome back. Well, for the markets, just about seeing a little bit of pressure for the mid-cap index, so just about holding its head above the water, up around 65 odd points. Let's see. It seems as though there's a possibility that it's going to slip into the red. That's the mid-cap index that I'm talking about. But let's see whether there's any kind of buying at lower levels which will come through. But tax increases in the budget may make India less attractive on a post-tax basis, says Samir Arora, founder and fund manager at Helios Capital. He also speaks about STT tax collections and capital gains tax. Listen in to excerpts from that conversation.
You are getting a lot of money on STT, yet STT you are not putting in that same pool, and therefore we keep saying that, oh, the equity guys are getting lower tax relative to the bond guys or the debt guys. But let me say one thing, that if it comes through, then in theory, the biggest beneficiaries will be the banks, relatively. Of course, everything might go badly those days, but relatively, it would mean that you are making it easier for the public to, not easier, but you're making the two a little bit more this thing in terms of tax preference. And what is the interest of the government, which it must be then that the asset allocation is getting influenced by tax considerations, although they are not transparently counting STT on the equity side and taking that as an aside and then saying the tax rate is low. Actually, it's not that different, I think.
One more thing, which again, this is we don't know if it will happen or not. Is on the debt side now, everything is taxed at the marginal rate except arbitrage.
That's a bit too much.
Arbitrage, and that may also get corrected. I don't know. I mean,
correct. That's possible. But right now, I don't go so deep. I just doing big picture that this is wrong to have remove STT, remove anything which is giving tax, and say no. But excluding that, the tax is low.
So suppose we do get some sort of a tinkering, right? Increase in holding period or increase in the amount, the rate. Markets will fall. Will that fall be a buying opportunity, according to you? Or do you think this will really unsettle the markets for a longer period of time?
It will fall, according to me, very simply about the same as the tax hike. Because let's say going in, you have a pre-budget expectation that you should make X% return. And so if you take 5%, it will fall broadly similar to compensate for the current holders. Then the new holders know that this is the new rate and all that, and then they change. So I think lifelong flows will moderate. As I said, it's a big picture thing. It doesn't mean it's bad or you'll have negative returns. But obviously, why should new allocation come in the same way if the expected returns from the market, instead of being 12%, are 11.4% or whatever, cut whatever? How can it be? I mean, that means these numbers have no meaning, that you can, whether your expected returns are 12 or expected returns are 11, it doesn't matter, because the models work like that, the thinking works like that, and the differences are only this much. It's not that 12% will become 5% return expected for long term. So obviously it matters when these big guys do their allocations, and you can see what happened in 2018, which was after a good rally, there was a tax hike of 10% effectively, because the long term was 0 before that and became 10. Now we can keep saying it is because of COVID, this, that, but if you see the cumulative flows of FIs in India, although they are good, they are not of the same scale as we used to have when we were a much smaller market. And I can tell you direct conversations, of course, these guys being, don't come on TV and tell you directly, but they are most bothered by the tax, because there is no set off, because they are tax exempt. For our investors or investors in ETF, there is no set off. They have to pay tax a second time in the US. Because if a guy comes into an ETF for 2 months and goes away, how to link the tax that the ETF paid with that underlying guy? What certificate to give him that this much tax has been deducted on your behalf? That is why the world doesn't take tax from foreign investors, for example. But here we are not saying that there should be a different tax rate for foreign and Indian. You please increase STT a little bit. It'll solve all your problems. You still get the same pool of money. You will also discourage short term. You will also discourage F&O indirectly by increasing that cost. You will get whatever amount you want. Just change the structure of how you collect it. You increase it as much as you want. I don't think any foreigner cares. It is just this, it goes into basically it's gone without having any this thing, because you might book like for example, first quarter is good. So you have accrued a tax. The NAV has become like that. Somebody has come in, somebody has gone out. And then there's a fall in the market. Now there's no tax to be paid. But somebody has redeemed at a low price, high price, all those things are the...
All right, with that, we'll slip into a short break. On the other side, we have our commodities segment with the birthday girl who's in the studio right now, Manisha. And joining her will be Prabir Bhattacharjee, Secretary General, Tea Association of India. Welcome back. The Nifty is now at 24,300, a firm recovery that we've seen from the lows of today. Some news coming in on data patterns, but no news bigger than the fact that it is Manisha's birthday here on today, and she joins us on the show. Manisha, I wish you a very, very happy birthday. The one commodity that I would hope that you have excess of in your life is happiness.
Thank you so much. That is a commodity, and that is something that you always look forward to. Thank you. That's an amazing, amazing wish. Thank you so much for that, Mangalam. But coming to commodities then, and there are various to talk about. But today we have focus on tea, where Prabir Bhattacharjee, he's Secretary General, Tea Association of India, joins us to talk about exactly that. Mr. Bhattacharjee, hi, thank you for your time. First of all, the tea prices have been surging. They're at a multi-year highs. What is your sense? Where do you see the prices going in from here? And when you look at the fundamentals pushing these prices higher, one is, of course, the production that has declined for sure. The export numbers sound good as well. So how do you look at many of these numbers playing out when we go forward from here?
Thank you very much. Good afternoon, Manisha. And first of all, a very happy birthday to you. Now, coming back to the commodity, coming back to the commodity that we are discussing, Yes, you're very correct over here. The prices have noted a surge in the last couple of sales. In fact, if one were to to divide the sales part from the beginning of the year, you see there are 26 sales that has taken place. From first to 16th sale, the prices were not moving at all. But from 16th sale to the 24th or 25th sale that has taken place, the prices have moved. In fact, the average from 203 it has come to 236. So definitely there has been a surge in the prices. But as you very rightly pointed out, this surge in the prices is riding on the back of the lower production that we had in the month of May and June. Now, Manisha, you'll recollect that, we were, the tea people, we always, crib about, small changes in the weather and all that. You know that in the month of April and May, it was an excessive, the sunlight that we were having over there. The heat was tremendous over there. There was no rainfall at all. In fact, the rainfall had, reduced to 50% of the normal rainfall that we had. But then what come the month of June with the monsoons, the rainfall has surged again over here. There's a surfeit of rainfall that has taken place. Now you see, either of the scenarios affect the production of the tea. And the net result is this: we are still, as on date, 44 to 45 million kgs behind on the production front, compared to the last year. So these are the
with 45. Yeah, with 45 million kgs lower than last year, this is until now. But for the rest of the season, going forward from here, what kind of a shortage are you working with?
Manisha, to tell you very frankly, the bulk of the tea is manufactured from the month of July to October. In fact, 50% of the tea, comes in these 4 or 5 months. It comes over there, more than 50%. So now, with the weather gods being what it is over here, it is very difficult to make a prediction. But the fact remains over there, to make up any 45 to 50 million kgs is a Herculean task. So the very fact, or if one were to prophesy, then are you going to make it up? That becomes a difficult job. We'll be very happy if it comes at par also to that of the 2023 production.
Okay. Now, with the prices, which are nearly 15% higher as compared to previous year, do you see them stabilizing here? Do you think there is still more upside to this?
I personally feel the prices should stabilize over there, because there's in perpetuity there's a shortfall of 45 to 50 million kgs. So that way one had to, if the basics are to be taken, then there should be this momentum should be continued over there. So that way the prices should remain over there. But then you never know what happens in tea industry, as it's supposed to be a very delicate commodity. Slight variations here and there, the whole result are changed accordingly.
All right. Mr. Bhattacharjee, also, how do you see India's demand growth now? We do understand that it's been increasing. The last time I spoke to you, which has been quite some time back, what are the numbers now that you have in hand?
Very frankly, the consumption rates, are not, something which one can boast about. We had a consumption rate of around about, under 800 grams, for many years. But now it's settled around to 840 to 850 grams per capita. But that is too low, And very well, I've told there are countries which have for example, Turkey. Turkey has a per capita consumption of 4.4 kgs, UK 2.6 kgs. So compared to that, we are nowhere at all. If there is some incremental growth in the consumption, much of the woes of the industry will vanish then.
All right. A final question then, Mr. Bhattacharjee, and this is regarding the budget. We do understand that tea as a sector also has gone through its own set of challenges. Are you anticipating some support, some subsidy, encouragement coming in from this budget?
Yes, Manisha, that's one area that I wanted to touch upon. First of all, as you know that with the industry, like any other sector, we are going through the climate change. So obviously, certain of the irrigation parts, we do expect some sort of or we do look forward to, if there is a wish list, that we should be looking forward to some concessions on the irrigation part. And most important, is this, that is that road tip, that's the embedded tax part, which has been extended to 30th of September, which is a mere 1.67%. In its previous incarnation, it used to be 6.7%. So that is where, we expect the Ministry of Finance and the Government of India to have a closer look. If that happens, some of the little subsidies, this matter a lot in these circumstances.
All right. One thing is what you've asked for, and we hope that one thing is what the Finance Minister definitely does give to you. But thank you so much, Bhattacharjee, as always, for joining us and making sense of the tea sector, where we have seen very huge price volatility and, of course, lower crop that clearly has been supportive of the prices. But with that, it's a wrap on Halftime Report. Business Lunch will take all the action ahead.
Thank you. Thank you. Thank you much.